Hey everyone, how's it going? Today is October 14th, 2022, and it's been a pretty interesting week for markets. We got that new CPI print, and this week we're going to talk about whether or not, albeit it being kind of sticky, 8.2% inflation, whether or not it actually signifies, when we're looking into the data, if inflation is slowing down. We're also going to examine what is going on with corporate bonds versus sovereign bonds. If you've been paying attention to the news, been watching other episodes or live streams of mine, we've been talking a lot about, the Bank of England and all these other governments around the world that are seeing their currencies collapse, having problems with their own pension funds, and very little in the terms and the ways of seeing corporations have issues with their solvency. And we're going to dive into the data to see that actually, in my opinion, corporations, and especially American ones, are much better positioned off for all of these rate hikes and financial instability than bonds are in some way. And, that's highlighted. We'll go into this too about how bonds have had their worst year in 100 years versus the stock market, or any market for that matter. And we got a bunch of quickie news as well that we're going to go through today. And lastly, we got some really interesting data from a survey conducted from the Bank of Canada about Bitcoin adoption in my home country, Canada. But it also is pretty relevant for the rest of the world too, as I imagine that it kind of looks the same in the US and other countries as well. We know 2021 was a big year for Bitcoin. Before we start, really quick, if I could just ask you guys to give this video a like down below. When I first publish these live streams, getting those likes in quickly in the beginning helps it reach more people. It's just the way the YouTube algorithm works. I'm not going to shill you guys anything besides that and then the sponsor somewhere through the middle of this video. But if you could do that, I'd really appreciate it. All right. So let's start off with what actually happened today, or this week. The big news of the week was everybody was kind of waiting for this new CPI print. And generally, the market's reaction is if inflation is higher than expected, the market goes down. And if it eases up, then maybe there's a chance for a rally. And inflation came in at about 8.2% in the US year over year. And that was generally interpreted kind of as a bit of a bearish signal. So on Thursday, when those numbers came down, we saw the market dip really hard. And then shortly after, I guess, the market digested that information, we saw a massive short covering rally. One of the biggest, from going from a pretty negative gap down print to a really high close that we've ever seen on the stock market, or at least in the last couple of years. And all that today, which is the last day of the week, kind of got erased. So if we dive into the charts here really quick, we can check out what that sort of looks like. So you got this big green candle here. This is QQQ, of course, but pretty similar results on SPY and Bitcoin as well. Big green candle here from the bottom to the top. Essentially, we had almost a 6% move here on QQQ. So that is pretty significant. Does not happen that often. And usually when candles close at their highs, if you're in a technical analysis, we know that they have continuation later. And we saw a bit of a gap up today, but basically for the rest of the day, the market sold off. And essentially, we're almost back to where we were on Tuesday or Wednesday. So, all that drama and volatility aside, the market didn't really end up going too far. Now, a couple notable things that I kind of paid attention to. One of the things that tipped me off about the rally, and I have a position, I have been shorting QQQ ever since the last FOMC. One of the things that tipped me off in that rally was this VIX. And I've been saying for a while, the VIX can just not get above a certain level. And I think it's just because there's a lot of people who are opening hedges and shorts, but ultimately they are being just forced to cover. And so what we saw yesterday is we saw a huge gap down in the market, which usually means a gap up for VIX. It means expanded volatility when you see, QQQ open up 2% down, but VIX didn't really do much. And then as shorts covered, VIX just plummeted. So that gave me some indication anyways, and it's something to really pay attention to when you're doing intraday trading, that if the VIX can't really see much continuation when the market is down, that is sometimes a sign of a potential reversal about to happen. Not always, but something to watch for as well. And then the dollar, which we've been paying attention to, had this big dip last week, consolidation, kind of going back into the highs. And of course, yesterday, I think, it moved a little bit inverse to markets, but nothing, too crazy. It's just consolidating at the highs. So in my opinion, I still don't really see a blow-off top in the DXY yet. I think it's still coming, I think the only way this really resolves with the dollar strength is with like a massive climactic move, but it's not quite there yet. And then, yeah, Bitcoin, when we just look at the price action on Bitcoin really quick here, it just looks super unremarkable because yesterday, we had a breakdown, broke some, support levels and then just rebounded for the rest of the day. But ultimately, now we're turning this 20,000 level into resistance. So whatever that means, I remain uninterested in trading Bitcoin as long as it is between 17,600 and 20,200 or 22,000. I just don't think there's, a point in taking any big positions in it until this range kind of dissolves or resolves itself. All right, technicals aside, because I am not a technical analyst by trade. I leave that to Dan of the Chart Guys. He's a lot better at it than I am. Let's talk about CPI. So we got this sticky inflation number. That's the new term, right? Inflation, it's not ripping as much anymore. We kind of hit that 9.1% in June, and now we're getting these between 8%, 8.6% inflation prints. Everybody thinks that, as soon as the Fed raises rates, inflation backs down, but you have to remember that CPI is this really lagging indicator. It takes data from months and months before, and it takes a long time to kind of deviate. So you can have an economic collapse tomorrow, and CPI is not going to immediately go down to 2%. I think maybe some people got conditioned to inflation moving really fast because of the pandemic, because we had this immediate spike to 20% unemployment rates. But when it comes to Fed easing and Fed tightening policy, it's not going to move inflation as quickly as some people expect. So let's look at some of the bright side to this, though, because I don't think we're going to see deflation very soon. But there are a lot of signs that inflation has peaked in terms of the print, the height of the print that we're going to get on CPI. So it's not deflating, but it's decelerating, in my opinion. And again, you probably know my thoughts on CPI. I think it's a terrible measurement. It's insane that the Fed uses something so backwards looking to try and change policy for the future, but it is what it is. And the market seems to react to the difference between people's predictions for CPI versus what it actually is. So it's still relevant if the market thinks it's relevant. So if you actually break down the numbers, month over month inflation has actually kind of peaked for 2022. We are not seeing an acceleration of month over month inflation. And this print kind of exacerbates that, or kind of demonstrates that. One of the things to kind of think about is that in kind of Q3 of 2021, remember all of these CPI numbers that we get are 8.1, 9% or whatever. They're based off of what inflation was in the previous year. And in Q3 of 2022, they were some of the in Q3 of 2021, there were some consolidation of inflation. And it really, if we remember, didn't really start ramping up until December, January, and then obviously going into the war in March. So overall, I think are going to start seeing lower month over month and year over year inflation numbers coming from this. There's a couple of other stats to kind of look at too. Earlier in the year, it was all about supply chain problems. Ships from China were not coming to the US at a great rate. Energy prices were crazy. They still are for certain parts of the world, but overall, things like commodities have come off, huge from their all-time highs. One of the things here to check out is that the World Food Price Index has now fallen for the 6th month straight in September. And also CPI and food and energy, while it's still obviously net up, it is declining and decelerating pretty quickly. And again, same with the cost of shipping from Asia to the US. So there's a lot of factors that there is some softening going on. And I think we will see that eventually factored into inflation. Now, one of the hardest parts, and I talk about this and I made a video about this, is that 40% of the way that inflation is measured is through shelter. So I think if you want to play that game of predicting where CPI or inflation is going to go in the future, you really have to pay attention to housing and rents. And so one of the things that is kind of important, and it might just be a little consolidation before the next leg up, is that average rental prices have been rising for almost 2 years straight, month over month. And In the last month or so, it was the first monthly decline in average nationwide rents in the US in a very long time. And again, that data is not immediately going to be reflected in future CPI, but it's something to pay attention to. It is a lagging indicator, but I think the expanding and the really high mortgage rates that we have now are finally tightening up the housing market. And it's, we're not quite seeing people panic selling housing yet. They're just not listing. But buyers have definitely left the market. And who this affects more than anyone is people who are buying properties for rental income because of the cost to finance. And most people who buy properties to, generate rental income are doing so through mortgages. That, bubble of people doing that is definitely gone at, 6 to 7% mortgages that people are paying in the US. So that's bringing down speculation in that sector, which I think has an impact on rent overall. Not to say that rent is getting cheap for anyone these days, but it's decelerating, and I think that's important to consider moving forward. What other things here? Yeah, from a technical perspective, I can't call a bottom on QQQ, but a pretty big day. One of the things to note is that on QQQ, the major tech index, Thursday, October 13th, was the largest volume that index has seen since May. And I really look at volume as kind of an indicator of climaxes. Now, again, it's just not guaranteed. You're not guaranteed to have a bottom here or anything like that. But those are usually signs to me that reversals can be afoot in traditional markets. One of the things that Dan from the Chart Guys has pointed out, which is really important to think about if you're doing intraday trading as well. And again, this is not an intraday trading show. What I really like to bring this perspective in is that sustainable bear market rallies are usually highlighted by hourly trend changes. So we didn't see that today. It's day number 8 that SPY and QQQ this time this year have not confirmed an hourly uptrend during regular trading hours. So yesterday's move that we saw was sort of straight off the bottom during regular trading hours, and then you get an hourly trend change after hours, but then during the day it's just no trend confirmation. And I think that's really important when looking for sustainable bear market rallies. It highlighted some of the other ones in the past, especially if we look back in I think August. During that bear market rally, we would see those trend changes midday, and that was what led to maybe a multi-week prolonged bear market rally rather than just like a 1 or 2 day one. So we're not out of the woods yet, is all I'm saying. But what are some good signs that we're entering some area of either consolidation or some bottom? And just specifically for the equity market, because I can't tell you what is going to happen with the bond market. I don't know that stuff too well, but it feels like we're entering a lower price to earnings ratio for companies. It feels like stuff is getting to be somewhat appropriately valued now. Maybe it's just a gut feeling maybe that we have. One of the things to kind of talk about is that the 60-40 portfolio officially as of this week, so that's 60% equities and 40% bonds, have now the worst year-to-date return in the past 100 years. So this is now officially the worst drawdown for most people's 401ks that has ever happened in a single year. Definitely, beating out 2008. The big difference with 2008 too is that equities got crushed, but bonds actually did pretty well in 2008. So if you had a diversified portfolio, you didn't get hit that bad. And now you can have a diversified portfolio and you would have gotten whacked. The only safe place it seems this year was in US dollars. So when we see these like events, and if you look historically, the worst years ever are generally followed by pretty good subsequent years. It's not a guarantee, but there's been so much recalibration and resetting of stock market expectations this year that I think it's a pretty low bar for next year to be a positive year for the stock market compared to where we are today. Another thing to think about too is that there are some signs that insiders are now deploying capital to buy stocks. So this is a really good chart. It only covers the last 20 years, but you can see insider buying is now reaching record levels last seen in the 2020, the midst of the pandemic. This is CEOs and CFOs buying their own company stock. 2015, 2018, all kind of like correlating with pretty severe stock drawdowns. So resolution of the internet bubble, record insider buying, 2008 collapse, record insider buying, and now we're starting to see it here as well. So a good sign that CEOs, which are really good capital managers, especially if they've been in the business for a while, are starting to see value in their own businesses relative to anyone else. Good signs. Not going to call for a bottom, but it's just good to see these like positive signs. Now, what do I want to talk about more so here? This year has been really strange to me because I think the expectation was we were going to get these rate hikes. And the first people to go were going to be things like junk bonds and corporations who were just spending like crazy and didn't do good capital management. And maybe down the line, banks. And then from banks, maybe sovereign nations, right? Bonds being really hard to pay back with these high rates. It's kind of like the way that we typically think of the hierarchy of financial crises. It hurts the over-leveraged little players first, and it works its way up to the big players. But the way that it's really worked out, seemingly from headlines, is that the big players, the sovereign banks, the pension funds that we've talked about in the show before, they are doing so much worse than corporations. And the big difference when you really look at what was going on was just the level of preparedness and the denial of things like inflation and the denial of things like we're going to a rate rising cycle. What I've really noticed, and we talked about this months ago, is that corporations, I think, have seen the financial tightening coming. They may have not predicted, what the terminal rate was going to be, but they saw, look, we're probably going to have to enter a recession to handle all this. And so what have corporations been doing for the last, few months? They've been firing people, they've been tightening margins, they've been shutting down these extravagant offices. There's so many anecdotal stories of all of these major tech companies and other businesses really tightening up and tightening the belt. And then if we look at governments, right, they're doing the exact opposite. They're deploying capital they don't have. They're leveraging things up. The central banks, like the Bank of England, is going out and it's bailing out pension funds. And then, what's going on in Europe is like a whole other thing. Like we have country after country in Europe going out and either printing more money essentially to help with inflation, or creating more money out of thin air, or borrowing more money from their bondholder base to pay for things like the energy crisis. So France is spending 100 billion euros to protect citizens from inflation. Germany is, putting 200 billion euros at work to protect from spiraling energy costs. And there's just this big deviation, and we've just seen it all year, of like the people who have been denying inflation, which is all coming from the top. It's all, the Biden administration saying it's not that bad. You have Lagarde saying it's not that bad. And then you have them now saying, 2 months ago they were saying no chance of recession. We're not going to enter a recession. And now everybody's saying, it might be a light recession. Meanwhile, CEOs have been saying, recession happening probably for the last 6 months to a year, right? So corporations who really have this fiduciary duty to make a return for their shareholders and have all these staff to take care of have been much more fiscally responsible than governments. And I think it's really important to highlight that, because everybody seems to think that there's a hierarchy of risk when it comes to markets, like corporations and equities are going to be hit first, and then bonds, because they're closer to governments, are going to do better. But I think this year has totally thrown that on its head, because we're seeing bonds, which are basically representations of people's confidence in governments to be fiscally responsible, doing, if not worse than S&P 500 or QQQ, which is just not really seen before. And I think it's all a result of just this endless quantitative easing that we've been doing over the last few years. Governments thinking that they have an endless amount of cash coming into their system, a reality that corporations just don't deal with, right? Corporations do not rest on their laurels and just assume that cash is going to come in forever. Corporations do not make their money through taxation. They make their money by having the best products and competing in open markets generally, or having a monopoly on something that people actually need to pay, like a utility or a service, right? And so we're getting to this point now where interest rates are going so incredibly high that governments eventually are going to be paying more towards the interest of servicing their debt than, how do I phrase this? If interest rates continue to go much higher than, let's just say, 4.5%, the amount of tax revenue that comes in, let's just say it's a couple trillion every single year, will not really have anything left over to actually pay for new things. There's like 1.5 to $2 trillion of interest payments to make on the $31 trillion of debt that the US has. And we get to a point soon where all of the tax revenue will just be going off to pay interest. Corporations just don't live in that reality. It's different. And one of the maybe analogies I'll give to some people who are used to trading is that corporations, when they run out of cash, they do one of two things, right? They either declare bankruptcy or they dilute. If you're in the marijuana industry, you've seen this all the time, and tech companies too. They dilute. They want to keep what they're doing going, and so what they do is they just issue new shares at certain prices, and it totally relinquishes confidence in the company, and it relinquishes the value of the stock price, but they dilute, right? And governments, by the same accord, what they do is they dilute the value of their currency, right? To cover old debts by issuing new money, they can handle the interest payments on it. But the value of currencies declining is very similar to the stock price of a company declining, I've kind of seen. And I think that's why this year, more than any other year, I have been paying a lot of attention to what the euro is doing, what the yen is doing, and what the pound is doing. And they are all hitting record low after record low versus the US dollar. And essentially what that tells me is that the US dollar is the least dirty sheet in the laundry. Everything else is dirtier, awash. People would rather go with the US, even if they're going through their own money printing thing, than they would with Europe, Japan, or the Bank of England. Bank of England today, or sorry, not Bank of England, but the government of England today, we saw just let go of their finance minister, right? So again, extremely declining confidence in sovereign governments, a lot more so than corporations. And that is the big divergence, and I think that's the story of this year's big macro picture. But yeah, that's my 2 cents on that stuff. All right, before we jump into the quickie news, quick break from our sponsor. Today's stream is generously sponsored and made possible by Ledn. Ledn is a platform on the forefront of Bitcoin-related products, allowing you to generate yield of up to 5.25% on Bitcoin savings, up to 7.5% on USDC savings, or use Bitcoin as collateral to access dollar loans, among a bevy of other great features. Ledn has institutional backers and investors such as Coinbase, Whitestar, and Genesis Capital. And it's the first crypto lending company to complete a reserves test certified by one of the most recognized accounting firms in the world, Armanino LLP. If you'd like to support the show and learn more about Ledn services, feel free to use the link in the description of this video and receive a $10 USD sign-up bonus. Alrighty guys, quickie news. Some of this stuff is just like macro stuff. It's not even quickie news, but I just found it of interest. This I don't understand, but maybe some people could shed some light on this. The US Treasury has apparently asked major banks whether it should buy back some US government bonds in order to improve market liquidity. So we know right now through quantitative tightening that the Federal Reserve is selling all those bonds they bought back to banks. And banks are actually sitting on pretty good piles of cash, but now the US Treasury is seemingly wanting to do the opposite of the Fed, which doesn't quite make sense, but who knows? We live in a fucking clown world these days. This is an interesting post from Brad Mills about Ronald Reagan's Grace Report in the 1980s revealed, and this is during the last big inflationary boom that the U.S. had, revealed that 100% of income tax collected went towards servicing interest payments on the national debt. And then interest rates dropped, and for decades that wasn't the case. But if you look through this, it's now coming back. And we can see in September, the Fed's net income for the first time ever turned negative. They're losing money on all their bonds as policy rate rises, resulting in more negative remittances to the Treasury. Kind of interesting stuff here. So yeah, federal revenue not doing so great. Going towards just paying off interest. And hey, look at this. We're talking about going into a nuclear war. You know how much that's going to cost? I will say, and I'm not a big fan of war at all, but one of the good signs is that high interest rates deter war. Now, people can just snap their fingers. The military-industrial complex has a lot of power, and they can say lower rates, issue money, buy more weapons, right? In some sense. But having this expensive debt that's kind of unescapable because the Fed needs to have their mandate of fighting inflation deters nuclear warfare and things like that. Although we're still sending obscene amounts of money to Ukraine, but that's another story. Interesting chart here. Global monetary policy. You can see this kind of like purple, these purple bars here are the amount of quantitative easing that the Fed is doing as a percentage of the world GDP. And in black, you can see the, I guess, I don't know what trillions or billions this is measuring, but this is kind of world GDP. And you can basically see that there's a very direct correlation between the amount of quantitative easing the government does and quantitative tightening, what it does, versus what is going on with global monetary policy. One thing to kind of think about, which is interesting, is that when I look at this chart, what I see essentially is that the monetary easing that was done during the 2020 pandemic almost led the rally in stocks. And it feels like this time the stock market foresaw the monetary tightening that had to happen and has been accelerating down quicker than the Fed has been able to quantitative tighten. But that's because we know that the Fed didn't really start tightening until I think like April or June technically, and the market had already fallen quite a bit since then. Quickie story, Tether. No, there's a couple Tether truthers out there, but last few months for Tether, they proved to be the only company able to pay back $7 billion in 48 hours. So there's a bunch of people who redeemed Tether, and people were worried, oh no, they don't have the cash to make it happen. And they actually redeemed 25% of the entire Tether supply for US dollars. So that means that people were going to Tether and saying, here are your USDT tokens, give us the US dollars. And Tether was able to fulfill 20 billion US dollars in 30 days. And rightfully so, I think they have the ability to brag about this. Ask your bank or other stable coins if they could handle that size of redemption of their reserves. Not likely. Usage of USDT is also increasing in a lot of developing countries, and they don't hold any commercial bank paper now. So they hold almost exclusively US treasuries. And I don't know how this works because they have very short-term treasuries, so I don't know if they're subject to the loss of the value of the treasury, but they essentially are getting increasingly higher yields. So I don't know how the balance sheet of Tether is doing, but the fact that they can just redeem that much capital that quickly, that gives me a lot of confidence that they are not going away or insolvent or anything that the Tether truthers say about them. Binance is now putting $500 million towards supporting Bitcoin mining. As we know, the hash rate hits record high after record high every single month, seemingly, even with Bitcoin in a bear market. And what that essentially means is that a lot of these mining companies who don't have cheap energy are going to be selling their machines in liquidation processes. And Binance, being the casino that it is, wants to get into the game, and so they've set aside $500 million to buy probably some of these liquidated machines and keep everything going. It's a very interesting market. There's no regulation, and it keeps doing its thing. Bitcoin volatility does not seem to affect miners. They just keep finding a way to keep this machine chugging, which is really cool. Netflix, those bums, they announced that they're going to be doing a ad plan. So you can officially go, we've officially come full circle. We went from Netflix killing TV to Netflix becoming TV. So now, if you're too broke to afford $20 a month of Netflix, and I can lump myself in that category, I stopped subscribing to Netflix just because the shows were kind of shit, and $20, you gotta wow me at least once a month. I unsubscribed, but now for all those people that did, they can resubscribe at $6.99, get 720p video, and have 10 minutes of ads every hour of Netflix content. And so I put a poll up. I'd love to hear your guys' responses. I don't know if I asked this one before, but like, how many people here actually have Netflix? Because I am on the train of like, I'm out of the Netflix game. Not really keen on it. Every now and then maybe there's like one good show, and I use the magic of the internet to find a way to watch that without being a subscriber, if you get my drift. But anyways, I don't see this taking off, and part of the reason is because you can get like a really basic Netflix plan, I think for just $11. So I think I would chew the $5 extra a month or $4 extra a month to have no ads than to deal with ads. And I know that Hulu did this model where they had, their $5 a month with ads plan and then their $20 or whatever without. They've been doing it longer than anyone. But I simply am not going to pay to have ads given to me. This is cable 2.0. Now, if they can find a way to give it to me for free, I think that would be competitive. And they can just charge their advertisers a bit more to make that happen, I guess. But I don't know. I just don't see anyone uptaking this. I'm very curious to look at Netflix earnings 6 months or 9 months from now and see if there's actually significant uptake on this. Maybe it's not a Canada-US thing. Maybe other countries will, but I don't see it happening. I just think that like people will bite the bullet. They don't want to go back to ads, and they especially don't want to go back to ads if they have to pay just to have them. All right, cool thing of the week. Meta announced new VR goggles, some new VR technology. Mark Zuckerberg's putting all his chips in that basket. But I watched a bit of it, and one of the coolest things I thought, which was cooler than their new headset, was these new avatars that they can create with 3D scans just using a phone. Because one of my biggest problems with VR, and I know that there's arguments for it, is that when you want to interact with people, you have these like cartoony looking avatars, and it's just lame. Like the whole point of VR is to kind of make it more immersive than your Zoom calls, but then you have these cartoony avatars, and I know that they can have facial expressions and all that now, but I still think it looks ridiculous. And so what they have done is they built this technology. They don't really have a use case for it, called codec avatars. And I'll just show the video so you can kind of see what that looks like.
All you need for the scan is your phone, and you can pretty much do this anywhere with reasonable lighting. She scans her face from different angles with a neutral expression for about 30 seconds, then spends another minute and a half making a variety of expressions. That's really all there is to it.
Hi guys, my 3D avatar is ready for use in my phone or VR. It just took a few hours to generate after my scan, and the team's working on making that processing a whole lot faster. Now, obviously this isn't the same quality as you just saw with the 2.0 codec avatars. However, they're still pretty expressive and realistic. We're putting a whole lot of effort into developing these so anyone can easily create their own high-quality, realistic avatar for themselves.
Yeah. Oh, look, my watch history. I thought that was cool. Essentially, like, I've never seen 3D scans or 3D modeling that's looked that good. Like, I've seen Unreal 5 engine modeling, but it doesn't look as good as some of those quick scans. I guess you're using LiDAR or something to make that happen. But that's amazing. Like, if we can have VR conversations with avatars that look that lifelike, then I think we're going somewhere. But I think that technology is probably at least 10 years down the line. But that makes it a more interesting metaverse. This idea of playing these like chunky looking Miiverse avatars in a chunky looking low texture world is just not appealing. Like, I want to get to the Ready Player One stuff where I cannot tell the difference, or maybe the Ready Player One world looks more high fidelity than the actual world. But I just think graphics processing and all that, the hardware, the cloud computing needed for all that is still at least 10, 15, 20 years away. And again, I want that. Is it marketable for, the intensity and the cost? I don't know. But that's the only type of metaverse I see myself playing in. It's got to be Avatar levels of realism. I just am not going to play like in a Minecraft world otherwise for more than like, my Christmas breaks just for shits. All right. Lastly here, we're going to talk about Canadian Bitcoin adoption. The Bank of Canada has put out a really cool report of Bitcoin ownership in Canada, and we're going to dive into some of the highlights in that. And Crypto Mags, she's also a local Vancouverite, has put together some highlights on this, which I think are really interesting. All right, number one, huge increase in the ownership of Bitcoin. So ownership of Bitcoin between 2016 and 2020 was around 5% in Canada. It more than doubled to about 13% of Canadians now owning Bitcoin, which is pretty cool. And so a lot of Canadians have cited that it's likely because of more savings, all the QE, all the CERB checks and whatnot. Why not put it into some Bitcoin? But Canada also has more avenues to directly invest in Bitcoin. We have our own Bitcoin ETFs here, unlike the US. So easier to put into tax advantage accounts. And yeah, we've had a massive increase in ownership of it. Also, because it went up, people like to gamble at home. Nice all-time high in 2021. Seems so far away now. When we look at the main reason to invest into Bitcoin, the main motivation, very few people are saying payment method. The blue line is recent owners and the yellow line is long-term owners. Most people are in it for investment and a return on their money, and that's fine. Surprisingly, people are in it because they want to be interested in new technology. So there's a lot of new people who own Bitcoin just because they wanted to dabble into it, and we'll go into that later. There's a very big knowledge gap between the owners of Bitcoin, and there's very few people with like intermediate financial knowledge that own it. The majority of owners of Bitcoin in Canada are either very low financial literacy or extremely high financial literacy, which I think is kind of cool. 70% of Bitcoin owners in Canada own under $5,000 worth, but recent old owners hold even smaller amounts, around $250 to $2,000. So a lot of people just dabbling their feet into it. I think it's really cool that in Canada we have the Shake Pay card, which is just 1 to 2% on all your purchases, cashback in Bitcoin. Really great. I see the future of cashback rewards really moving towards cryptocurrencies because people understand that the dilution in typical points things is almost worse than it is in fiat currency. Like if you have Aeroplan miles or Shoppers points or whatever, right? Those things get diluted a lot faster than inflation dilutes things. Scene points especially. That one's just been terrible lately. So you're going to see a lot of people passively making Bitcoin, I think, in the future, which is going to be great. Recent owners are less likely to use Bitcoin for purchases than longer-term owners. I don't even find this that compelling because you cannot, under our current tax system in Canada, it's very hard to, as a business, accept Bitcoin. So most people, again, just into it to invest it, not actually use it as a currency, and that's fine. I would say even in El Salvador, where they do have it as a legal tender, most people are simply just not using it because the wallet that the government of El Salvador has set up makes it as easy to transfer US dollars between other wallet holders as Bitcoin. So you might as well just use that feature. So I think there is a future of Bitcoin for payment methods, especially with the Lightning Network, but obviously in Canada, it's just not really a ripe environment for that. Bitcoin businesses take notes. Mobile apps are essentially the main way for Canadians to buy Bitcoin, and 23% of Canadian Bitcoin miners mine as a way to obtain Bitcoin, which is great. So yeah, most people are buying Bitcoin on their phones more than their web, especially new owners. So everyone's got, Robinhood, Wealthsimple, that's how they're getting their Bitcoin. 10% are getting them through Bitcoin ATMs, which is interesting. And then fewer people now than 2019 are getting them through these peer-to-peer transfer services. Longer-term Bitcoin owners are more likely to mine, use Bitcoin ATMs, conduct P2P deals to acquire sats. Perhaps they value their privacy more than recent investors. Probably true. Canadian Bitcoin owners hold substantially higher amounts of cash than non-owners, and longer-term Bitcoin investors tend to hold more cash than recent investors. So there are, as much as we like to say that we hodl and we live on a Bitcoin standard, apparently the Bitcoiners in Canada keep a lot of dry powder to buy dips, or, maybe they're cashing out at the top, or they're using let-in to stake their Bitcoin as collateral and get loans. Who knows? Canadians have seen their share of lost keys, ICO scams, problems with transactions, stolen funds, but large price corrections are the most common adverse incident reported by Bitcoin or crypto owners. So most people who report problems with the crypto space are just mad that the price is going down. So that's good. We're definitely getting better with exchanges, less ICOs, all that stuff. 89% of Canadians have heard of Bitcoin in 2021. BC leads and Quebec lags. This is super cool to me because I am a British Columbian boy. We are leading Bitcoiners in Canada here. I can't tell you why. But it's really neat. Maybe it's because we are so driven to find alternative investment mechanisms because our housing market is so ridiculous here in BC. But yeah, and again, what we're seeing here too is that, Bitcoin uptake, financial literacy, low and high are the people who are really adopting Bitcoin. And then also, kind of clear here too that, this is the awareness chart. There's one about actual buyers here. Class of 2021 showed a low level of Bitcoin knowledge versus previous years. They thought that Bitcoin is backed by governments. The Bank of Canada used a question to tell if somebody had a low understanding of Bitcoin, and that was basically, is Bitcoin backed by government? And surprisingly, a lot of the new people who bought Bitcoin this year thought that Bitcoin was backed by government. So that is an opportunity for people like me to get into the education space, because there's a lot more Bitcoin owners, but they're coming into this space with a very little understanding of how it actually works. And price usually begets curiosity. So who knows, when the next bull run comes or price goes up, more people will watch videos like this, which is good for me. I'm in a good space at least, right? Bank of Canada found 16% of Canadians owned at least one other owned a crypto, Bitcoin or an altcoin. 10% owned both Bitcoin and alts. 6% owned alts exclusively. Boo. Bad story. 6% of Canadians own altcoins but no Bitcoin. We got to figure that stuff out. Politicians take note. An anti-crypto stance could alienate 16% of your voter base, and likely more in 2022. That will only increase. I'm a big proponent of that stuff. So, people will get better understanding Bitcoin and crypto, and if the politicians don't keep up, they lose votes. Simple as that. Most popular altcoin was Ether, and then Dogecoin, and then Bitcoin Cash, surprisingly, more than almost any of the other ones. More than Tether, more than USD Coin, more than BNB. I don't know who owns Bitcoin Cash. I think a lot of people just think it's like a cheap version of Bitcoin still, unfortunately. The Bank of Canada observes higher ownership of altcoins for longer-term crypto holders. Recent owners are more likely to buy Bitcoin. I suspect awareness and Bitcoin name recognition plays into this. Canadian Bitcoin owners were more likely to be male, age 18 to 34, with a university degree or a high income. No surprises here, but look at this. So when we look at percentage of Canadians who own Bitcoin, 19% of British Columbians own Bitcoin. 12% of Ontarians, Quebec 11%, Atlantic Canada 6.2%. I can't quite figure that out, but if there's any BC people in the chat, let me know what you think is behind that. I don't know why West Coasters are so much bigger owners of this stuff. Maybe disposable income? I have no idea. It doesn't make a lot of sense to me. And then, ultimately, I love this chart. Stack sats on the low IQ bell curve, acquire Bitcoin at the high end, and then in the middle, no, you've got to have a balanced portfolio. Investing requires careful due diligence. Make a savings plan. Pay off your expensive loans. Save for a house. Think about your pension. Choose a credit card with a bonus program. Bitcoin's a Ponzi scheme. Yeah, well, middle IQ misses out, but high IQ and low IQ wag me, I guess. All right, that's it for today's show. I'll dive into the chat, see what you guys are up to here real quick. All right. Step 2, Mr. F. I stole Makiko's Netflix, our Netflix. Switched my Netflix bill to pesos and it's peanuts. Yeah, living in Argentina. That's interesting. I heard now that they have 100% inflation. I thought 80 was bad, but 100% is just crazy. At 100% inflation, when you pay your taxes, and I assume the government of Argentina just accepts taxes in pesos, by the time they actually get your taxes, they're not really getting anything, because the beginning of the year you're making a certain amount, but by the time you pay your bill off, it's worth like half the amount. So I don't know. I don't know Argentina, how that works. Food is also looking backwards. We haven't seen the potential shortages due to government mandates restricting fertilizers. That crop hasn't hit the market yet. Dave McIlroy, I would like to know if that's that prevalent in a lot of other countries. We talked about how Sri Lanka had this big move to like all organic fertilizer. I know in Europe they're pushing it, but first of all, I have to figure out, who are the major food producers in the world. I think Mexico's a big one. We know Ukraine had a lot of wheat, but if those places aren't switching to organic fertilizers, I don't know if that's that big of an issue, but I'm curious. There's a lot of different factors at play there. Keep calm and have a high tea. Thanks, Mom. You either die a hero or live long enough to see yourself become the villain. Looks like a deep fake with your phone. I wonder if that whole example was kind of exaggerated. Like, I think when they do that scan, it probably takes like hours to render that out. But everything just gets faster, right? So eventually we'll be able to just go like this and generate 3D models of our face. I don't know how the body works, but who knows? Maybe we'll have body scanners at home at some point. Lots of teaching and learning still required in this space. Yeah, it's the individual's responsibility to do the work. We'll be here when the new corner is ready to learn. Yeah, well, I'm working on some exciting stuff when it comes to teaching and educating. I think it's just a matter of, as more capital enters this space, there will be more opportunity for educators to expand their reach. Because right now, if you just look for Bitcoin education, you're going to find videos that were made in 2012 to 2021. You're going to find YouTubers like me yapping at camera, but I think there's some opportunity to really expand the production value of this stuff and to speak to people about Bitcoin in a more interesting way than just me to camera. And while I do find myself very interesting, I'm sure that there are hundreds of thousands of people who will never, ever in their life open up a Bitcoin standard book or watch me yap about macro stuff to a camera for an hour. So I am really trying to think about different ways to get this Bitcoin message out to more people to talk about hard money, whether it's through things like comedy, through things like interviews, through things like going in person to places, making that kind of engaging content that is just all over the place that you would maybe see on a talk show, but have it themed slightly towards educating and piquing people's curiosity about Bitcoin and hard money. So look forward to that stuff. Maybe Vice type of documentary stuff. Who knows? Who docs themselves by disclosing their sacks? Perhaps BCers are use less OPSEC. I mean, for these like Bank of Canada polls, I actually wonder what the sample size is as well. There's very granular data in there, so I imagine that their sample size is at least 5,000 people, bare minimum. But I would say, I don't know. I don't tell people how much Bitcoin I have, but you can always like fancy a guess when people tell you when they got into it, and then you can fancy a guess based on like what are they doing. Because if they're like me and they're making this shit, then maybe that tells you, how early I got Bitcoin and how much I got from it, rather than I got into it in like 2014 and I'm working at working at a fast food joint. Maybe you didn't buy enough back then or you sold too early, right? So yeah, I don't know. OPSEC. I definitely respect the Bitcoiners' desire for added privacy, but I think also as you become a public figure, that expectation changes. So personally, I have a different sort of empathy for people's financial privacy. I like to kind of spill the beans on the table, and eventually that's going to be someone coming to my house with a wrench. But I don't know, live fast, eat trash. Maybe that's one of the things I say. But yeah, I think for most people, we're going to have to learn how to protect Bitcoin stacks. But at some point, the risk of publicly saying you own Bitcoin is going to be very low, because it's the same risk as saying, as wearing a watch or driving a fancy car. It just becomes ubiquitous. And so, yeah, you could mug somebody who says they have Bitcoin, or you could mug somebody that says they have like a Lamborghini. What is going to ultimately be easier to coerce? I don't know. But I don't want to give anybody any ideas here, so I don't know why I keep talking. All right, guys, that is it for today. Thanks so much for tuning in. If you have any other questions, feel free to enter them in the chat below or in the comments section. I'm more than happy to answer anything from people. I hope you enjoyed today's show. I will be back next week. And if you are on Twitter, follow the Bitcoin Well, because I'm going live with them on Monday with the CEO, Adam O'Brien, and we're going to talk about the Bitcoin mining industry in Canada and how it could open up a lot of job opportunities and other things like that. So it'll be a cool thing, and eventually we'll do the video recording of it too, but it'll be a live thing, so you can submit questions and we'll kind of answer them on air and all that stuff. All right, thanks so much, guys. Take care. Have a great weekend.